Hello everyone. Welcome to the last video of chapter 5. In this video, we're going to talk about separate class and when you can make an election to put items in the second class. When we discussed disposition, we noted that terminal loss can only occur when there's no assets left in a particular class, when our bucket is empty of assets. So this creates an issue. If we buy something that we know is going to become obsolete, something we know we're going to dispose of, that makes it tricky when we have other assets in the same class, because here's this thing we bought, we're going to get rid of it, but we can't recognize a loss in value, a loss in terminal loss, until everything else is sold. So this can occur, especially in a common class like Class 8. Class 8 holds a bunch of different things. General equipment, furniture, kilns, vats. So there's a lot of different things that go in this particular class. So let's say we bought a photocopier that we know we're going to replace in 3 years. It's not going to get fully amortized in 3 years, but after 3 years, it has no more value. So we get rid of it, we replace it. But the UCC that was remaining in the class 8 stays and it gets reduced by 20% each year. And then we buy more photocopiers and more equipment and more furniture. And then we're getting rid of the furniture. We get rid of this equipment doesn't work anymore. We get rid of it, but those UCC balance just continue to accumulate and then take CCA and then we buy some more stuff and it accumulates. This can create a situation where we just have a whole bunch of UCC sitting in our class that doesn't relate to assets anymore. And we don't want to wait to be able to deduct it. So when we have assets that are faced with technological change and obsolescence, certain properties, if placed in a class with other properties, would be prevented from ever claiming the terminal loss. If there's too many other assets or properties, we'll never be able to get that loss. So we can elect to have a separate class that would allow a terminal loss to be claimed since the property is the only property in that class. So this is very commonly done with photocopiers. It's eligible for Class 8 properties, photocopiers, electronic communication equipment, and certain computer software, only if it's in Class 8. So this is an election for Class 8 because Class 8 is such a catch-all for so many different types of properties. The capital cost of the property also needs to be more than $1,000. So we can't just take everything that we would put into Class 8 and just give them all their own little class buckets. They have to be a specific type, photocopiers, electronic communications, and they have to have cost us a certain amount of money. So if Class 8's beginning UCC is $225,000, we buy a photocopier for $25,000, it's added to Class 8. In year 3, we sold the photocopier for $5,000. So the UCC balance in year 3 would have been reduced by the lesser of proceeds, $5,000, or capital cost. Since other properties remain in the class, no terminal loss is allowed. So this shows so we bought this photocopier for $25,000. In the first year, we took 20% of CCA, so we deducted 5,000. Now the UCC specific to this photocopier is sitting at 20,000, 25 minus the CCA taken. 20,000 times 20% is another $4,000. 25 minus 5 times 20%, we've deducted another 4,000. This is the CCA in year 1. 4,000 is the CCA in year 2. The net result is our $25,000 has a carrying UCC balance of $16,000. The disposition is the lesser of proceeds and costs, so we will dispose of $5,000 for what we received, and that leaves $11,000 sitting in the class. There's $11,000 sitting in the class. We got rid of the photocopier. So that $11,000 is just going to take 20% this year, and then 20% of the remaining balance the next, then 20% the year after that. Whereas if we could put this in its own bucket, its own class, we could deduct that $11,000 right away as terminal loss instead of having that $11,000 stuck. Other other classes that normally have a separate class election is non-residential buildings for class one. There's enhanced CCA rates for new non-residential buildings. Basic rates 4% can increase 10 or 6, depending on the use. I'm not too worried. We've already covered the rates of class one. The reason it's highlighted is because photocopiers have the issue where they might become obsolete quickly, leaving a large balance. Buildings have the issue is they last a long time. So if we had three buildings, we put them all into one class, they're all very expensive. They're hundreds of $1,000s each. So having 3 buildings in the class might be a couple $1 million. A few years down the line, we dispose of one of our buildings. Let's say we disposed of it for less. But now we have remaining UCC for that particular building sitting in our class, and it's going to take years to get rid of it, especially at a rate of 4%. So that amortization rate is very slow. So if we were to result in remaining UCC from a disposed building, it's going to take so many years to fully realize that reduction, that loss from our income. So class 8 is for assets that become obsolete very fast. We get a separate class election for class 1 because buildings are very expensive and the CCA rate lasts a long time. Let's get to the exercise to drive this home. In January of 2025, Edverness Inc. purchases 10 photocopiers at a cost of $20,000 each. In December of 2025, so in the same year, 2 of the photocopiers are traded in for faster machines with more features. The new photocopiers got $22,000 each, and the company received a trade-in allowance for each old machine of $3,000. In 2025, we bought machines for $20,000 each, and we only got $3,000 when we traded a couple of them in. So that's a huge reduction of value in 1 year. The company uses a calendar-based tax year. What would be deducted from business income if no election is made, and then compare it to if an election is made. So let's see if I can make this understandable. This first section is if we make no election. This is if we separate them into their own classes. If we do nothing, we added $200,000 of machines, of photocopiers to our asset pool. We got rid of 2 of them at $3,000 each trade-in value. We got those proceeds are $6,000. So we bought 200,000. We got proceeds of 6 that subtracts, and then we use those proceeds to get, well, we traded in for 2 additional photocopiers at $22,000 each. That's additional capital cost of $44,000. So the total combined effect of all of our photocopiers is an addition to the account of $238,000. At CCA of 20%, we can deduct from income CCA of $47,600. We got rid of 2 photocopiers this year. If we had put each photocopier into its own class, so we had 10 classes, I guess 12 if we include those 2, how would it have been different? Now, for simplicity, I've summarized the classes that have similar effects, but really this would have been 12 separate classes we calculate separately. In summary, the 8 photocopiers we kept, we bought 10, traded in 2. Of those original 8 that we kept, their addition to UCC is $160,000. So on them, we took 20%, 32,000. That's regular CCA. We will deduct that from income. Our 2 new photocopiers that cost us $44,000, they get added to the class. We take CCA, so we'll be able to subtract $8,800 for the CCA on those photocopiers. These are the photocopiers we bought and kept in the year. Their combined amount of CCA is $40,800. So this CCA total was $47,600. So $40,008 is about $6,800. So the 2 photocopiers that we disposed of had an effect on CCA of $6,800. But if we were able to get rid of them, we added $40,000 to our classes. The proceeds was six, so there's $34,000 left behind. Because these two elected classes are now empty, instead of taking CCA, we will subtract it from our income as terminal loss. So we'll be able to deduct from income the $40,800 of our regular CCA calculation plus $34,000 of terminal loss. So our total deduction from income this year is $74,800 instead of our deduction from income in a normal situation of only $47,600. So $74,800 minus $47,600, we're subtracting an additional $27,000 from our income. At a general tax rate of 15%, that's going to save us $4,000 on our taxes. By being able to move our copiers into their own classes, it makes it easier to recognize terminal loss. And that terminal loss will in turn save us tax money now, right now, in the year we got rid of them, instead of waiting for them to amortize over time. So that's the benefit of the separate class election. The reason we had this at the end is because you need to understand terminal loss. So we revisit this just after we talk about dispositions. If you have any questions, hopefully you understand how to do a basic CCA calculation, those special classes, 13, 14, 53, how to do dispositions, when does recapture and terminal loss occur, and the benefit of a separate class election. That's it for chapter 5. Thank you for your time. See you in the next chapter.